are 910, consideration of acceptance of the June 30th, 2022 report of the Lake County Pooled Investments. And this is, I'll give this over to Susan as it says your name, and then I'll let you hand it over to, okay. Oh, Patrick, there you go.
I can do it through Zoom. Okay. Good morning. Patrick Sullivan, County Tax Administrator. I'm here with Carlos Oblitas from Chandler and Barbara Ringen, our County Treasurer Tax Collector. Chandler Asset Management is going to present a report on the county's investments. I can put the PDF up on the screen if I could have the sharing enabled by the host.
There you go.
All right. So go ahead, Carlos, and you can tell me where you want me to go.
Absolutely. Good morning, everybody. Good morning, supervisors. Why don't we skip page 3, which has all the text that you can read on your own. I'm going to keep this very conversational, and perhaps we can go to page number 5. And I want to focus on the chart on the right-hand side. I think I've come in here for the past 3 quarters, and I've updated you on this, and I've focused on this very topic. We have very high inflation in the United States right now. I don't think that's news to anybody. You see it when you drive your car and go to the gas station and fill up your tank, paying for food. You're probably paying prices are much higher than they were a year ago. Those inflationary pressures, which were caused as a result of a quick reopening of the economy, plus record stimulus from the government, plus low interest rates, which made it very cheap for businesses and people to borrow money. All these things increased the money supply, and we have inflationary pressures in the United States. The reason I'm focusing on this is because those inflationary numbers, the inflation numbers that you're looking at on this page here, are driving interest rates in the markets, and those interest rates move around both the value of your existing investments as well as the future earnings that you will have in the portfolio. So I want to talk about those from an economic perspective. We'll keep it very brief and high level, and then we'll move on to what's happened in the portfolio. So all good news, everything is fine, but I do want to highlight some things that we've got our eyes on. So I mentioned that inflation numbers are higher, and the reasons for that. The month of June saw 9.1% inflation year over year, as measured by the Consumer Price Index, which is an index that most businesses look at and use. That number came down for the month of July down to 8.5%. And this very morning, as I was driving up here, the number for August was released. It came in at 8.3, which was higher than the anticipated 8.1. For that reason, the stock markets at this very moment are actually losing value. You're seeing the numbers come down considerably, and there's quite a bit. If you can Google it and just see what's happening in the news, pull up the newspaper, and you'll see that the stock markets are witnessing a lot of volatility this morning as a result of it. Investors were expecting that the Fed's measures to combat inflation, the Federal Reserve, that's our central bank, would be more effective at this stage, but they haven't been. They still have more work to do. It's also leading most investors to believe that the Federal Reserve will raise interest rates for another time. It would be the 4th time this year, this calendar year. And every time they've done it at a 0.75% clip every time, which is considerable. So if we flip over, Patrick, to page number 11, I think it's helpful to look at the chart on the right-hand side. It's the Fed funds, the effective federal funds rate. That's the overnight lending rate between banks. The Federal Reserve manipulates that rate by setting a target for it, and then they do something called open market operations to move it around. But basically, they're moving around the cost for banks to borrow from one another on an overnight basis. And this sets the tone for short-term rates and also longer-term rates. So that hike in interest rates that you're seeing is their attempts to slow down the economy by making it more expensive for businesses to borrow money, for investors to borrow money. And as a result, it's more expensive. It pushes people out of borrowing and it has less liquidity, they have less access to money, which should hopefully pull buyers away. If you think about perhaps like the housing market, that's a really good example. If mortgage rates go up, you have less people that are able to afford to buy that house, so they remove themselves from the market and prices don't get pushed up as much. Well, the Fed is doing the same to the economy. They're raising rates so that businesses that can't afford to borrow at these higher rates are no longer expanding or spending money and pushing those inflation numbers up. That's just an economic term to say they're fighting inflation. They're trying to slow the economy down by fighting inflation. The net result of that is that it will slow the economy down, and it could push us into a contraction where the economy actually shrinks rather than grows. We've had that. Patrick, if you back up one page to page number 10, you can see the table on the left-hand side. That's happened now for 2 quarters in a row. Some people are asking, does this mean that we're in a recession now? I'm just looking at the table on the left, the bottom row. You can see the March numbers. The economy shrank on an annualized basis 1.6%. And then in June, once again, at 60 basis points, 0.6%. So investors are asking, is the Federal Reserve doing so much to slow the economy down to fight inflation that are they pushing us into a recession? We're not quite sure if we're there yet. The normal definition of a recession is 2 back-to-back quarters that are negative, which we have. But there's more to it than that. One key measure that investors look at and economists look at is employment going down as well? Are we seeing a hike in unemployment? And employment is quite an opposite picture. We have very strong employment in the United States right now. We're creating jobs at an average over the last 6 months of somewhere around 375,000 jobs a month. Prior to COVID, we only needed about 140,000 to absorb new entrants into the labor markets. And we were creating much more than that. We're back to pre-COVID levels, is what I'm saying. So that bright spot in the economy leads a lot of people to think that perhaps we're not quite yet in a recession, but they're keeping their eye on it. All right, what does it mean to you? Why the Economics 101? The reason is because if you turn to page number 12, the chart on the left-hand side shows you the history of yields available in the markets for 2-year investments, 5-year and 10-year investments. Remember, and these are measured by U.S. Treasury bonds. This is the U.S. government borrowing money so that they can do their activities, just like sometimes local governments borrow money to do what they need to do. So this is their cost of being able to borrow that money, and that cost has been going up. If you look at the dotted purplish line at the bottom, that's the history of the yield for 2-year treasuries. So that's the government borrowing money for a 2-year term. And if you kind of eyeball December of 2021 for that rate was at 70 basis points, 0.7%. Is where it started the year. That's what it was costing the government. So if you were an investor at that time and purchased a 2-year bond, meaning you borrowed money from the U.S. government at that time, you were only going to earn 0.7% per year for the next year. That rate has hiked up to 3.5% through the end of last month, and as of this morning is at 3.76. That's a dramatic rise in a very, very short time. And that's a result because of inflationary pressures and the Federal Reserve's attempt to slow down the economy. Yields are much higher in the government, in the markets right now. Why is that important to you as a county and the county treasury? The reason that's important is because any new investments, you have bonds that you hold in your portfolio, and as those bonds mature, they will be reinvested. But rather than being invested at 0.7 at the beginning of the year, these bonds are now going to be reinvested somewhere in the range of 3.5, 3.7, 4% over that. So you're going to see higher interest income coming into the Treasury, and that's very good news. We haven't seen rates like these in about 12 years, 12, maybe 15 years. The inflation numbers that I showed you, we haven't seen numbers like that since the early Reagan era. So I'm just trying to put things in perspective. So this is very good news. This rise in rates is very, very good news. It means that your earnings, when I average out the annualized earnings rate that you earn on the portfolio, as bonds that with lower yields mature and leave the portfolio, and new bonds, they get replaced with new bonds with higher yields, the overall average yield is going up gradually, and I'll show you that in just a moment. Now, there is a flip side to this. The flip side, the cost to all of this, of course, is that as rates rise, the value of your bonds goes down. Whatever you're actually holding right now, that goes down, and it has gone down significantly because of the rise in rates. Now, does it matter? Yeah, yes, it always matters. In fact, your auditor controller will book that drop in value, even though it's a drop on paper. It's not going to get realized. You would only realize the loss if you sold the entire portfolio, which that's not a practice of the Treasury. The Treasury generally holds to maturity. But if you hold to maturity, you will not realize any of those losses. The losses just go away. You get your money back at maturity when the bonds that you've purchased, the issuers of those bonds, pay you your principal back. So the only concern is, what is the ability of those bond issuers to pay you your money back? The ability is very, very strong. That's one of the reasons you have a very strong investment program. You have a very robust investment policy, which sets parameters up to buy only very high credit quality issuers. You have an investment advisor who's doing credit work on the issuers that are in the portfolio. So there's a lot of safety and liquidity and a lot of risk management going on. But that's in essence, that's where we stand. Higher rates because of higher inflation. It's providing you a tailwind into earnings going into the future, but at the same time, the value on paper is dropping. You're not going to see that. You're not going to realize that value that drop in value on paper. You will not realize it. You'll see it in your financial statements, but money-wise, it's not going to hit a budget or anything like that. If anything, you should see the apportionments go up into the future. So that's the backdrop, and I'll touch on the portfolio. But before I do that, let me take questions.
So when we started meeting last summer, when we were working out our strategy, and we chose the shorter term investments when we were working together. And so you've been slowly buying those over the year. And so I just want to make sure that the rest of my board and the public understands, like, that was really good timing for us when we did that. And just, could you explain that so that everyone's aware?
Supervisor Paiska, you and I and Supervisor Sabatier and a number of other people, including your treasurer tax collector and the county administrator's office, we all sat in a committee where we reviewed the economy, and we forecast what we thought would happen in the economy. And one of the decisions that we made as a group during that time was that we would we would target an average maturity for this portfolio, and that average maturity was going to be shorter than what other counties and cities do. We kept it shorter on purpose. And the reason that we did that, the reason that all of us collectively, you included, made that decision was because we anticipated that interest rates would rise, and we wanted to limit the negative impact, meaning that drop in value on paper. We wanted to limit that by staying a little shorter. The longer you are, the more of the impact. But also, functionally, the shorter the average maturity of the portfolio means that the faster bonds come due, which then become available to reinvest at increasingly higher yields. That was a very deliberate thing that we did, and we did that collectively, and indeed, it has worked out quite well. It's been a very good strategy.
Thanks.
Any other observations, comments before I touch on the portfolio itself? Let's take a look at page number 14. We'll be very brief here. Again, this has been a collective work with your treasurer tax collector. It's been collective with members of the board, with the county administrator's office. This is everybody's had a hand in this process to move it to where we are today. So the portfolio is. I just want to remind everybody the portfolio is designed for safety and liquidity. This is not a speculative portfolio. You cannot buy stocks or real estate or private equity or commodities. You're not allowed to buy any of those things in these funds. These funds are invested in very high credit quality, interest-bearing debt securities. They're bonds, which effectively make you a lender, and you collect interest income on these securities. By law, you're not allowed to go out beyond 5 years, except with some special circumstances and permission from this board, but we don't do that as a policy. The primary goal is to generate interest income for the pool participants, and then of course for the county's money, so that you're able to earn something on your money while that money is held to be spent in all the activities of the county, like public works, like construction for roads, like salaries, like any initiatives that you have. So that's the nature of the portfolio. Pages 15 and 16, I'll briefly touch upon. This is a summary of your investment policy, which currently complies with California government code. One of the reasons that you work with us is to ensure that the investments meet the letter of the law, and that they meet the letter of your policy, and they do. This is a summary that we supply the Treasury and the Treasurer Tax Collector on a monthly basis. We oversee that as well. If we turn to page 17, this is a consolidation of your entire investment program. So this encompasses a portion of this is managed by Chandler Asset Management, and a portion of it is managed directly by the Treasury, being held by your Treasurer Tax Collector, being held in pools, county pools, the state pool, local agency investment fund. You're the county pool. But basically the investment decisions are made on a day-to-day basis. They're made by us in line with the strategy that was given to us by the committee we worked with, and in line with the policy and state code. As of August 31st, so we were rushing to get the latest numbers. So that's as of 13 days ago. The portfolio stood at $425 million, almost 426, a little bit lower than 3 months prior, back at the end of May. Back in May, it was $450 million. This is typical. It's a typical cycle for county treasuries, as county treasuries collect taxes in the run-up to December and in the run-up to April, and for the rest of the year, they spend down that money as the participants in the pool pull that money out, like your schools, to spend for their needs, and the county as well. So you really won't see an upsurge in collections until you start seeing tax collections starting in late November, early December. So there's a rundown in the balances, but as of that date, you have an average maturity of 1.5 years. And again, the portfolio that Chandler manages is targeted at 1.8 years. When we blend in the money that's invested in the state pool, in local agency investment fund, it brings that average down just a little bit. It also brings down the yield, because the investments in the pool are lower than what we have in the portfolio of securities. But you're at 1.5 years. Your duration is 1.34 years. That's a risk measure, letting us know how much of an impact the portfolio would have in its market value if interest rates were to move. That 1.34 basically says if interest rates were to drop 1%, you would gain 1.34% in value. If interest rates rise 1%, you would lose 1.34% in value. It's a risk measure. You can see it's very low risk. It's a very low volatility portfolio. As of the end of August, the effective annualized yield you're expected to earn on this portfolio, the way things stand in the portfolio, is 1.44%. The standalone portfolio is in the 1.55 range and growing. You can see, indeed, the consolidated portfolio 3 months prior. If you look at that average purchase yield, it was 0.98. Today it's 1.44. So investments with lower yields mature and drop off, the money comes back, it gets reinvested in higher yield, moving the average higher. The market yield is the yield that you would get if you had purchased this portfolio on that date. You can see that it's grown because market yield in the markets have grown considerably. So here's another way to think about that. When something matures, if we reinvest it back in the portfolio and purchase securities that look just like the portfolio is structured today, we should be picking up yields averaging somewhere around 3%. So it shows you how the new yields are impacting the purchase yield, that 144 I showed you earlier. Very high credit quality, you're averaging AA. If we go to the next page, I'm going to focus on the chart on the left-hand side. Almost a third of this portfolio is invested in U.S. Treasury obligations. This is the county lending money to the U.S. government. That's considered the safest investment pretty much in the world. Very high credit quality. You do lend money to corporate issuers, very high credit quality U.S. corporate issuers, single A or higher. And they don't just make into your portfolio because they have a single A. We do credit work, which is part of the risk mitigation process that we do. We don't just buy any credit out there. We're looking for certain metrics and certain standards that they meet. Local government, you can see the LAIF, LAIF, Local Agency Investment Fund. That's the state pool. The Treasury uses that as liquidity. So they simply withdraw money out of there or put it back in. It's almost a little bit like a very high yielding, very well run checking account is what it is, and that's where you write your checks off of. That gets rolled into the county's bank account, and from there is where you write the checks. But it's there to earn a little bit of a higher yield than what you would get in the banks, and it has overnight availability. We don't manage that. That's just the money gets moved in and out of there for the county's needs. You have. I also wanted to highlight just some of the other names in here. You do lend about 14, almost 15% of this portfolio to federal agencies like Fannie Mae and Freddie Mac. They're government-sponsored enterprises. But you can see that this is a really well-diversified portfolio. You can also see if you just skip pages 20, go down to, if you would, to, let's see if we put it in here. We didn't put it in here. That's all right. What I wanted to highlight was we've also diversified not just in the security types, but we've also diversified in the maturities. We hold maturities all the way out to 5 years. If we have the ability to do that right now, you don't have anything longer than just a little bit over 3 years. That's part of the strategy. As Supervisor Paiska highlighted earlier, we're trying to stay a little bit shorter because rates have been on the rise, and that allows us to capture those higher rates a little faster. But you can see the makeup of the portfolio, a little bit over 30% is either in investments that are overnight or shorter than 90 days. So that's a lot of liquidity, but that's being drawn down on, and it will continue to be drawn down on until we start seeing the run-up in tax collections in November. So that's a very typical and a good liquidity position. You have money and you have it available when you need it, which is one of the requirements of code. If you look at page 22, we can see the yield to maturity history, and you can see that so this is at every point on that line is looking forward what you're expected to earn on an annualized basis. So you can see that number has been on the rise, and again, it's for that dynamic that I showed you earlier. We're shorter, rates are higher available in the markets. When things mature, we reinvest in higher yields, driving that average higher. So those are the highlights. I think that going forward, it's important to keep an eye on the volatility in the markets right now. Inflation is really playing havoc, not just in the United States, but in Europe and abroad. The European Central Bank recently raised rates. The Canadians have been right behind them. Inflationary pressures are a theme on a global basis. We've had disrupted supply chains from Asia. We've had strong pent-up demand as COVID winds down, and consumers like you and I are now, well, we've been saving money and we've been sitting at home, and now we want to take that vacation. If you try and rent a car or buy a flight, they're going to be very expensive. So that has to be tamped down. This is very high inflation. It has to be tamped down. The Federal Reserve, it's doing its work to tamp it down, but that work to tamp it down is slowing the economy down. The side effect, because of their activities, is that we have higher yields, which should propel your earnings going forward higher. But of course, the value of the investments on paper are dropping as a result of that. Not to worry, you're not going to realize that. The things that would make us realize it is if you had credit problems. Businesses who are doing so poorly that they're not able to pay you your debt back. And that's not the case here, quite the opposite. Corporate America is doing quite well. So let me pause there and take any questions that you may have.
All right, well, I think that concludes the presentation that we have for your board today. At this point, the action that's recommended by staff would be to accept the report, unless your board did have any other questions on this.
No, thank you for this update, and I'll see if there's anyone in the public that has any questions on this item on the agenda. Looking online here at the same time. I don't see any hands up, so I'll bring it back to the board for action.
Mr. Chair, I'll move to accept the June 30th, 2022 report of the Lake County Pooled Investments.
Second.
So I have a motion and a second. All in favor? Aye. Opposed? Motion carries. Thank you very much, sir. Thank you, Barbara, and thank you, Patrick, very much for this presentation.
Well, and thank you for working collaboratively on this and getting us in this much stronger position that we were in a year ago.